My name is Ismail Ray Reyes, and I'm the managing principal and founder of the Admirable Group, we're one of the general partners on the Park Valley Apartment Homes investment opportunity. Joining my team today, the Admirable Group team, is Charles Seaman and Prashant Kumar, managing partners of Cashflow Champs, who are the ones that found the initial deal and brought it to us. Part of what we do in this business is we partner with people that are doing the same things we are, that have significant experience, and we put all that experience and all of the effort, we put it together to find these terrific deals that then we can give to passive investors who don't have to spend the time doing all the legwork. We'll present the information, we do all of the due diligence, we put in all the risk so that the passive investors, all you have to do is submit some capital to the deal and then just wait until we provide those inputs, which we do often. And you jump in a little bit into the Q&A, but we will keep you informed on this deal, but not to the point where you feel like it's onerous on you. This is our responsibility to keep you informed, and we all win with these great deals. So I would say, hopefully you all have had an opportunity to review the investor presentation webinar recording that has been put out on social media. It's been emailed to you all from one of my partners or myself. And I know that we've had a significant amount of investors that have already started the process of getting on this deal, which includes providing a soft commitment, signing investor documents, et cetera. So we're in the process with a lot of people. This deal doesn't have a ton of time left, and we've got quite a bit of interest. So hopefully, if you are thinking about doing this thing, you take this as an opportunity to really get all of your answers or your questions answered, and then you move forward quickly. If you have not had a chance to see any of the previous webinar recordings or any of the investor presentation or been on the investment portal, and we'll talk more about that. At the end of the presentation, we'll have essentially point of contacts for all of my partners and myself, and whoever it is that you've been working with, just shoot us a note. Whoever you found out about this, shoot us a note, and we'll make sure that you get that information tonight so you know what the next step is and can move forward from there. So I'm hoping that most of you have seen it. Every once in a while, we do get someone that's new, and this is your opportunity to catch up. So I'm going to go ahead and go to a disclaimer here. Just want to make sure that everyone's aware that this investment has risks, right? All investments, there's no difference there. We do a lot of the legwork to give you as much information on this, but there is still some risk. So I'd say review all of the material carefully before you invest, just like you would with any investment. So just take that and do that. One thing I will add, that this opportunity is only for accredited investors. As I mentioned, since this is a Q&A session and we've already had the bulk of the information passed to you all in previous settings and previous recordings and meetings, et cetera, I'm not going to spend a ton of time going over the deal itself and all of the intricacies of the deal, just going into all of the entire business plan. But that is all in the investor presentation webinar and the document. So again, we'll give you that if you need it. What I will say is that you're going to love this deal. At a time when most people, you think about it, can't finance a personal residence for less than 6%. We're talking about a 3.48 fixed interest rate, 3.48 fixed interest rate for 9 years. It's hard to believe, but it's 100% true on this deal. This property has already had 97% of the units renovated conservatively. So in other words, we've conservatively underwritten this property so that when we say that we can get you a certain projection of returns, it's because we've conservatively underwritten it. And so we're able to do that because this isn't one of those value add deals where there's a lot of possibilities of how fast you can turn units and how long you have to keep them empty while you're doing renovations. There's none of that. Essentially, we are able to provide significant cash on cash from the very beginning because it's a stabilized asset. And boy, technically it's a C+ class, depending on who you ask, but it really feels, and I was just at the property yesterday, and you just have to be there to get that feeling. It is very much like a B-class asset, someplace that we would all want to live at. So let's start off with a little video on the property. And after that, I think we'll jump right into the Q&A. Back to the presentation now. So this property it's hard to, even though you see it on the imagery there on the video, It's hard to believe how big it actually is. It's a significant asset. 326 units, over 20 acres, with a ton of space to really add value via amenities to our tenants and our clients there. So there's a lot of upside that really doesn't stop us from collecting rents because we're not doing the value add on this one. It's just a tremendous opportunity. So I'm going to, at this point, turn it over to one of my partners to start off with the Q&A. Let me make sure we are in shape here. I think this is the first one. All right. So how did you find this deal? I'm going to actually turn this over to our partners, Charles and Prashant. Charles, if you want to kick it off, I know that part of what investors like to hear is, how did you find such a great opportunity? And so I think that's part of the story that needs to be told, because these, you just can't find these every day. So it takes a lot of work and a lot of needle in the haystack type luck to get something this good. And I'll turn it over to you for this first one.
Sure. Ray, thanks so much. And we do have a pretty good story about how this one came to be. So it started out as an on-market deal in the late part of 2022 and early 2023. Offers were submitted mid-January. And initially, there was a handful of groups that advanced to the best and final round, which we were one of. Out of those groups, we actually had the lowest price of any group that advanced to the best and final round, which is the part of the story that I like. You're probably wondering, well, they had the lowest price. Why do we win the deal? Initially, they went with the highest bidder, and that highest bidder was over $1 million higher than we were. And this particular property was being sold as a portfolio with the second property that the seller had in the area. And the same bidder won both deals. So they dragged out the contract signing for a while. Then they determined that they couldn't close the deals, and they backed out. So next thing they did was they went back to the second highest bidder. They were about $750,000 higher than we were. And at that point, that buyer was no longer an option because he had a 1031 exchange. So he couldn't sit around and wait. He had to go out and find something else, and he did. So now they're left with 3 other offers, all of which were considerably lower than those top 2, and which we were the lowest of. So the broker is one that I have a good relationship with, and transparently, he told me he didn't want to deal with one of the other buyers because he knew they were very difficult, and they weren't really sure the other group could close. So they were trying to push the seller in our direction. And after some talking with the seller, they felt confident in our ability to close. The broker put some good words in because of past experiences and because of our track record. And lo and behold, we wound up winning the deal, even though we had the lowest price and the best in power round. So we have a good cost basis. And the track record went a long way to help us secure this great investment opportunity.
Thanks, Charles. That's very good color on that one. And it's not every day that the lowest bidder wins the deal, but hey, persistence matters. And so does experience and all the other things that come into this. And I don't know if you or Prashant want to just touch on how much hard money is on this deal, because I think it just talks to how much confidence we have that this is going to be a winner.
Absolutely. So this deal has a lot of hard money. So on day one, we put up $750,000. And for anybody who's been looking at investments for a while, that was pretty common in 2021. There was probably quite a few offers I submitted with even more than that we lost because we were on the low side of that. But with where the market is now, that's not as common. So why do we put so much money up? What's the biggest variable that's out there now? Debt. So we felt great about the debt on this deal because of the leverage, because of the interest rate. And because it was already set, it wasn't something that we were going to have a variable as we try to close the deal for the next 3 months. So we figured if we can go lower on price and higher in non-refundable money, it'll increase the odds of us winning. And that's certainly played a factor in it too.
I think Charles is a little bit humble in saying the fact that we were confident that we will do this deal. And the fact that we were the lowest bidder is the confidence and the relationship with the broker that we can do this. That's what made it different. That was different with us. Coming up with $750,000 hard, that's certainly no joke. And broker felt that and seller felt that, and that's why they went with us.
Yep.
Fantastic. That's good color as well, Prashant. Thank you very much. So let's roll with the questions. I see that we already have some folks asking questions. If we don't address it during our fixed setting here of questions that we've already received, we'll make sure that we address it before we hang up today. So we'll just hang tight and then we'll roll through these. And I think a lot of them will get answered as we go.
Okay, so here is the very first question, and it's what are the financing terms? So we have a fantastic debt terms, as previously mentioned. We are assuming the seller's Fannie Mae debt at 3.48%. The long term has 9 years remaining, with approximately 20 months of interest only payments until January 2025. Here's the next one. What are the limited partner general partner splits? After the preferred return is paid, the equity split is a straight 7/3.
So I get some questions on what preferred return is. So pref return is it simply means that before anyone gets anything outside of the limited partners that putting up the majority of the capital, we are paying a certain percentage. And on this deal, there's three classes of investors depending on how much you invest. So you have a class A investor. If you invest $500,000, you get a 10 pref. That means you get 10% as your minimum before anybody else gets anything on the general partner side. If you have 250,000, between 250 and 500, then you have an 8 pref. And if you have 100,000, you have a 7 pref. And those are the three classes of investors that guarantees some level of return on these deals before, again, you share anything with the active group. But we're confident that we're going to do much more than that, but we are at least guaranteeing your bottom line. So I think that's the key to that. My apologies, Alfredo, for putting that on you there.
Oh, no worries. Okay, so here is the next question. Are the general partners investing in the deal? Yes, we are approximately investing $1 million, including $750,000 in non-refundable escrow funds, plus legal and due diligence costs. So this is what we are referring as hard money. That's $750,000. It's basically non-refundable.
Great. So now we're going to move into talking a little bit more about the property itself. And I've had a lot of great conversations with investors and a lot of you that are on this call today over the last week or two. And one of the most common questions I've been getting is about the foundation work, because we very clearly have it in our investor presentations and making sure it's very clear that there is foundation work. And so addressing that, yes, it's foundation work. I think that terminology is a bit strong. By and large, of the $600,000 line item that we have for the foundation work, it largely consists of installation of vapor barriers underneath the 15 buildings. And that is really to protect the buildings and minimize the moisture, as well as adding new underfloor insulation. So the property didn't have these vapor barriers. And so with the moisture, the existing underfloor insulation is starting to deteriorate. So that's the bulk of this line item. Now, what I think about is traditional foundation work, if you will. We do have 2 of the 15 buildings that are showing settlement. So 2 of those buildings, we will be going in and adding additional peer support to those particular buildings. Now, the $600,000 line item that is in the pro forma, we feel really confident with that. We actually got 3 quotes on this work. 2 of the vendors actually went underneath all the buildings. And so they were able to provide very accurate quotes that we're feeling really good about in the underwriting. And Ron, that was a great question. So if we move on to the next slide, please. So another question, Ray mentioned it early on. Do we need to be accredited investors in order to invest in this deal? Yes, you do need to be an accredited investor. We are adhering to the 506C exemptions with the Security and Exchange Commission. So this investment opportunity is only open to accredited investors. And just to reiterate what that qualification levels are, the 2 most common ways to qualify as an accredited investor is having a net worth, either personally or as a household or as a couple, of $1 million or more, excluding your primary residence, or having annual income of $200,000 or more for the last 2 years, with the expectation it will continue for an individual, or $300,000 as a couple. And for this particular property, I know some of you have invested in other deals with our team, and depending on whether we adhere to the 506C exemptions or the 506B exemptions, with this 506C, we do require that, or the SEC does require that we gather verification of your accreditation status. So prior to wiring any funds, you will need to verify your accreditation status, and that can easily be done through a letter from your CPA asking them for that. Or another service that I've used previously and have had a lot of great experience with investors is a third-party verification site, verifyinvestor.com. They can easily turn it around within 24 hours, provided there's nothing too complicated. And as far as how can you invest in the deal? So a lot of times we think about investing cash in a particular deal, but you can invest with cash individually in your own name. You can invest with cash through your LLC. You can invest with cash through your trust. You also have an opportunity to invest in this deal through retirement accounts, like a self-directed IRA or solo 401k. There are some nuances. So you'd want to have a conversation with your sponsor contact when it comes to the depreciation benefits, because when you invest cash, you do get tax forms and you get the depreciation benefits. When you invest through retirement accounts or tax advantage accounts, you do not receive the depreciation benefit because that is already a tax efficient vehicle. And then a lot of questions, right? When do distributions begin? So you invest in the deal, you make the decision to invest in the deal. When are you going to start seeing cash flow from it? As with many deals that we do like this, distributions typically start 6 to 12 months after acquisition. For this particular deal, we are underwriting that we will begin distributions after the second full quarter of operation. So roughly 6 months in. We're looking at closing on this deal in May at some point. And so we are looking at beginning distributions starting in January 2024, and they'd be quarterly distributions moving forward from there.
All right. So on to everyone's favorite topic, taxes. Next question. Will I get a K-1 or 1099 as a tax form each year? And the answer to that is yes. You will receive a K-1 or the appropriate or applicable tax form for you. We do aim to send those K-1s out by March 31st each year. We don't have direct control over that. Obviously, there's accounting firms that are going to be creating those. But what those K-1s will represent is any profits or losses based on your investment. And we will get more into that on the next question. All right. So will you do a cost segregation study for accelerated depreciation? Yes, we will. So we will begin this process after acquisition. And current estimate is that you will be able to depreciate 40 to 50% of your investment in year one. Again, what we do is we get that accelerated depreciation and then we push it down to you, the investors, so that you can get what we call a paper loss on that K-1. Okay, you're ready. You've decided to invest. What do you do now? So what you're going to do is sign into your investment portal and make a hard commitment to invest and just complete all the documents within the system. Most of those should be self-explanatory, but obviously at any point during that process, if you have any questions, make sure that you get a hold of your respective sponsor. And if you don't have the link to that investment portal or you haven't set one up yet, they'll be able to get that to you. And all of this will be included in a follow-up email along with the recording of the session that, again, your respective sponsor will send out to you. So when do I need my funds ready to wire? All funds should be ready for wire by the first week of May. As Kelly mentioned, make sure that you're talking to your sponsor so that they have everything that they need on their side. So your accreditation status, etc. And it's always the good practice to talk to your sponsor to make sure you have the correct information prior to wiring. But subscriptions are filled on a first come, first funded basis. So it is essential to complete the subscription agreement, accreditation verification, and wire funds to secure your investment spot, because there's always the potential that this could become oversubscribed. And then unfortunately, you wouldn't be able to get in on this opportunity. All right. So where do you wire your investment? Well, again, wiring information is available in your secure investor portal after you sign those subscription documents. So again, if you have any questions, just reach out to your sponsor contact for assistance if you need it.
Okay, I think we've gotten to the point now where we can get to some of the questions that have percolated here on both the Q&A and the chat. What I do want to do before we get that, because I think just to clarify, Charles, can you just jump in and clarify the aspect of the deal when we overperform? So we perform to a standard. There's a baseline that says anything over either 7, 8, or 10%, that has to go to our limited partners before the general partners, the active investors, get anything. But there is a little bit of an upside for us if we overperform on this deal. And reality is, if nobody should be upset if we overperform. We get a little bit more. You've also gotten more because obviously the rates are higher. So Charles, just jump in and talk a little bit about that if you don't mind.
Yes, absolutely, Ray. So when Ray's saying, oh, well, what this deal includes is an IRR hurdle. So you may have seen the slide a few slides back where it talks about the 70-30 split, which are above the preferred return. So the second hurdle would be an IRR hurdle. So once each investor class hits a 16% IRR, then anything over and above that would change to a 50-50 split. But keep in mind, that doesn't start until each investor class gets at least a 16% IRR.
And correct me if I'm wrong, I'm pretty sure we've got this one right, that regardless, that stuff has already been baked into our underwriting. So that doesn't change the numbers in any way. It's already factored in.
Correct. Yep.
Good. All right. So I think we've got some questions here and we'll take those. There were some questions, several questions on the foundation work. So I'm just going to list those off to make sure that we covered them. And if not, we can add some more color to that. And I don't know if Charles or Prashant, if you guys want to add some additional flavor, that'd be useful. So the first question is, how quickly did you model the property getting to, okay, that's not the one, sorry. Hit the CapEx one first on the foundation. For the CapEx foundation work involving insulation and vapor barrier, was a mold inspection done on each building and what was the result?
So to give you an answer to that, I would have to read through the due diligence report a little more in depth. What I will tell you is over the course of a 3-day span that we did the on-site due diligence inspection, we had somewhere between 30 and 40 different vendors out there. So I'm fairly certain that we probably did do a mold inspection, but I'd have to read the report a little bit closer to give you a definitive answer.
So what we'll do, Charles, if it's okay, we'll get that answer back and we'll get that added. This Q&A is also being recorded. So we'll make sure we address that in the recording that goes out to all of you so that everyone gets the benefit of the answer on that one. Okay. Let's see. And I think there was one more again on the CapEx here. Okay. No, that was just a repeat. Okay. So got that.
Right. And then I think where you're going is in the comments, there was a question about the renovation and 97% of the units being renovated and a question of whether they're full or partial renovations.
Go ahead and answer that, Kelly.
So the 97% of units that are renovated, they are full renovated units. So they've got stainless steel appliances, granite countertops, nice white, I think it's white or light gray, but I believe it's white cabinetry throughout. So they are full renovations. The seller is actually they were an operator who is very focused on CapEx and repositioning a property from a CapEx perspective and then getting it leased up as quickly as they possibly could. Hence, there's a little bit of meat left on the bone, quite a lot of meat left on the bones from a value add from a market rent, getting up to market rent perspective. But they are full renovations of those 97 units. And we have in our underwriting that we will go in and complete the renovations of the 7 remaining units. And I think that leads nicely then into another question that we had in regards to the underwriting and how quickly we'll be getting the property up to full market rates. And if we can add some color on the anticipated renewals versus new leases.
Sure. So we can definitely do that. So with the modeling, what we're showing is 2 years as the time frame for that to happen. So the average rent at the property now is $11.33, and we're projecting to take it to $13.56 with the push the operational value at over the first 24 months. So there will be a good amount of new leases. So in year 1, we're showing 18% between physical and economic vacancy. And we're expecting to see some turnover. We're expecting to see some tenants leave as we start pushing rents. But we're also expecting to see a lot of renewals because what will happen is a lot of these tenants get frustrated when they get their renewal notices. What they'll do is they'll go on Zillow and they'll go on apartments.com and they'll see that a lot of the comps are already charging those higher rates. So a lot of them will wind up actually staying anyway.
So we've got another question. Thanks, Charles, about using Parallel as the system or the third party vendor to do the accreditation, the verification of accreditation. And the answer is yes. We've done some Parallel as the name of the company. I don't have the website for that one because we do, and we've used a lot, verifyinvestor.com, but Parallel does work.
So any accreditation done is valid at least for 1 year. So I think the question was that the earlier accreditation, would that be valid for this project also or not? And the answer to that is yes. If it was done recently in the last couple of months, obviously it will be valid for this project as well.
Yeah, typically the letters have a date on them, an expiration date on them. So I think that'd be the key, is just taking a look at what that is. Thanks, Prashant. All right, so we've got that one. And we have another question here with regards to other income. This equates to 2,700 a year a unit or 225 a month per unit and grows throughout the whole. It seems a bit high. Can we break this out a little bit?
Yeah, we can definitely do that. So there's definitely a lot of different other income that the seller's collecting. It's one thing they've done a really good job at, and we would expect to continue receiving that. So a large portion of that's going to be utility bill backs. There's water, there's pest control, there's trash, there's natural gas. So that's definitely a pretty substantial portion of it. There's wash and dry revenue in certain cases where they're renting appliances to the tenants. They have renters insurance income. They have pet fees. They have late fees. They have application fees. They have admin fees. They have some month-to-month fees they're collecting the tenants that don't have definitive terms on their lease. So they also have some legal revenues for reimbursement to tenants that they have to file evictions against. So those are things that we anticipate continuing. It's something the seller's done a very good job with, and we anticipate being able to continue receiving those sources of income.
Yeah, and I went out to the property yesterday, and I hate to admit it, but I acted as a prospective tenant just to get a good answer on some of these things, just get a second look to see if anything has changed. In many cases, really a third look, because I'm sure we've had several folks look over time just to make sure to verify these assumptions. And sure enough, all of these are part of the other income that's being charged currently to new tenants. And the rents that they have right now are, some of them are, what they're asking is exactly what we expect to be getting to in a year. So then they're asking for that now. So I think we're in really good shape moving forward. And we're being conservative while we underwrite this. Any more questions, guys? I'm scrolling through here, but sometimes
Looks like there's another one that came in from Luke.
we get Luke in here live. He's been on a few here. So let's get him live. Let's make sure we've got all of his taken care of.
Luke's awesome.
What's that?
Luke's awesome. That's
Yeah.
a great question.
Hey, so that means he's done his homework, and that's great. Let's see if I can get.
We want all of our investors to do their homework and be confident and comfortable in choosing to invest.
All right, Luke, you can get on there, man, if you want to chat with us here and make sure we get all your questions answered.
Cool. Thanks. Can you actually hear me?
We can.
Cool. Yeah. So just on the underwriting slide, I was hoping there was a version of that in order to get ultimately to net cash flow. So obviously showing financing costs, et cetera. Is there a version of that available for folks?
We can send out a version that you can take a look at. That's not a problem. Obviously, to try to go through underwriting here on the presentation can get.
Absolutely fine. Totally got it.
Yeah, we'll get that to you for sure, Luke. Just make sure you reach out. I'm sure you've got a POC already, and we'll get that to you quickly.
Cool. Thank you.
All right. Any other questions here? I thought I saw a few more on the chat. Help me out, guys. Got quite a few back and forth here, but I think we've answered a lot of
Did
them.
we,
Discussion.
Ray, there was one question, and I don't know if you guys answered. Forgive me, a few of the folks that were in here were texting me as well. So did we answer the question from Andrew in regards to having the low interest rate, just shy of 3.5% interest rate, and why there was not a refinance? Did we answer that question yet?
No, so that one was in the chat box, so maybe got mixed, but we can
Okay.
get some color on that.
Yeah.
So right now, and this will probably also tie into Luke's question. So we don't need a refinance to give distributions out. And that's one of the things that we like about this deal, because the deal has very attractive debt. So let me paint the picture here. Let's say that we're terribly wrong. Now, I don't think we're terribly wrong, but let me just say this. We're terribly wrong on the income projections. And we take the income that the seller has right now with no increase in anything. The actual in-place income, we increase the taxes, we increase the insurance, we increase the repairs and maintenance, and we increase the turnover, which they're currently capitalizing a lot of those expenses. So with increased expenses, the exact same income the seller has, in year one, we'd still be at a 6% cash-on-cash return. That's if everything goes terribly wrong. Let me be clear on that. So we feel pretty good about being able to pay out distributions throughout the life of the deal. Now, the offering documents do include the possibilities for a refinance. It's not something we have built into the underwriting. It's not something that we're leaning on as a primary strategy for this deal, but we always keep it in there as a possibility just in case it's needed. But with this deal, we have great debt. We have an opportunity to go in there and increase rents because there's a clear gap between where the subject property and the comps are. And between those factors, we feel pretty good about being able to pay out distributions to the investors without any type of refinance.
Awesome. I see another question here about the 97% internal, 97% interior renovations. I don't think we answered. We did answer that to some extent, but just to clarify, these units have been renovated to premium standard. Very good looking units. I think there's only 7 that need to be, that are classic at this point. I know that are classic. When I walked the properties yesterday, the occupancy, there was only like, I want to say it was 12 units that were in the process of essentially getting released out of 236 units. So out of those 236, 97% of those are renovated. And so based on the numbers, about 97% occupancy right now. Yeah, I'm with you, Charles. No matter, things stay just as there is and we do nothing, we're cleaning up here. Any other questions?
Yeah, maybe I'll come off mute again. On the CapEx, I know we talked extensively about the foundation work, so I don't want to hit that one again, but I know there were a number of other items in there, lighting and parking lot striping and other, I'm going to call it visual improvements and some landscape maintenance. Can you just talk about or give us some color and context around how you think that's going to improve the appeal or safety of the property? Just want to get that color.
Yeah, sure. So why don't we start with the roof work? Because that's the second biggest item in there. So the roof work. So basically, the roofs have all been reshingled within the last 4 years. We were unhappy with the work they did on the soffits and the roofs, so we included some money in there to bring that up to standards that we're more satisfied with. The dusted on lighting, the purpose of that is to keep the property well lit at night. And one thing we always find is that a well lit property keeps crime away. So we want to make sure that we're doing everything we can to be responsible owners and to keep the property safe for our residents and also to make it desirable for tenants that want to move in there. Most of the other items in there are things that won't necessarily add value to the property per se, but they're more designed for maintenance and upkeep. So with the seal and stripe in the parking lot, you probably need that every couple of years anyway. I don't think it's something we need to go in there and do on day one. But if we hold this property for 5 years, there is a good chance we are going to need it. And probably the time to do that is as we're positioning the property for sale, so it looks nice and fresh for an incoming buyer. So keep in mind, some of the things with the CapEx will be cushioned where we're not necessarily going to go in there and execute them right away. But there are things that we want to put in there because as you get ready to sell the property, you want to make it look as attractive as you can to get a maximum sale price for it.
Yeah, and I would say one thing that's interesting, and you always, when you go into these projects, I'm thinking like the seller now, there's 2 options, right? You go into a value add deal. What do? You fix the interiors in conjunction with the exteriors. You do one versus the other. A lot of times you want to do the opposite to some extent. You want to do, or a mix where you have some premium units, but you then fix the exteriors to such a way that you really attract the right kind of tenants to that project. In this case, focus specifically and strictly on the interior renovations and left really the exterior work to someone else to come in. And so essentially we just have to make the place look nicer to bring in better tenants to just bump rents a little bit, right? We're not talking about crazy bumps here. And so I think that bodes well for us because we don't have to do the heavy lifting on this, but we do get the benefit of when they walk in the door. We're not going to lose them when they're looking at units and the units aren't up to standard because we do want to bring a quality tenant to this product.
Let me mention one more thing about the immediate area. I'm sure Ray can attest to this too from seeing you yesterday. So on one side of the property, you have new development. You have townhomes being constructed right now as we speak. So that's gentrification coming to the immediate area. On the other side, you have I-20. So you have the convenience and the accessibility of transportation. So even though the property is right next to the interstate, it's a sizable property with a lot of trees, a lot of landscaping. So it really drowns the noise out and it's not something that becomes a detriment to the property. So an improving area with accessibility, nice units, and soon to be an even nicer exterior. I think that's a good mix for attracting a nice tenant demographic there.
Excellent. Anything else from the audience? Did we catch everybody, team?
We had another question come in regards to the forecast and the improvements. How long are those expected to take for those change? How long is it expected for those changes to take in order to be finished? And I know you touched on a little bit that some of them might not be immediate, but if you'll talk a little bit more specific. And then also, are we keeping the same management company or are we hiring another?
Yeah, sure. So the improvements, we have a budget of 1,336,000. The general approach that I take to improvements is we always want to budget for as much as we think we need, but spend as little as we can. And the idea behind that is if something ain't broke, don't fix it. And unless there's a benefit to it. So we want to have money there just in case, because over a 5-year hold with the 70s vintage property, it's very possible things could need to be repaired. So having that money up front allows us not to need to go back and get additional capital later on. So which items are we going to do right away? Dust and dawn lighting, that'll be an immediate day one item that we want to focus on. The structural work, we'll probably execute that pretty early on in the first couple of months. Same thing for the roof work. So those will probably be, and also the laundry room, converting the maintenance shop to a laundry room. So those will probably be the 4 items that we address right away. The rest of the items will really be done as needed. And that can mean, if the parking lot's in great shape for 4.5 years and we're getting ready to sell the property, then maybe we'll do it in year 4, month 7, as we get ready to sell. So it's nice and pretty. Some of the items there may not really be a need to do, but we want to make sure we have money there just in case it's needed. And with regard to management, we are hiring a different management company. The seller has first-party management, so they are managing it in-house. They also are keeping their staff. It's actually part of the contract that we cannot poach their employees. So we will be hiring a new management company and also new staff at the property.
Fantastic. Follow-up question here, that all places have bad payers, assuming people that basically delinquency, is I think another way to put that. What is the plan to get those that do not pay out of the property?
So the only plan that we have is to follow the legal system we've established and go through the eviction process. And one thing that really attracted us to this property. So DeKalb County, where this property is located, unfortunately, since the pandemic, has been very slow getting people out. One of the things we liked is that this property does not have a lot of delinquency, and that's just a great selling point for it. But as you said, there's always going to be some, because that's with any property. So for those that don't pay, we will file evictions and we will work to get them out as fast as we can. DeKalb County still has a fairly significant backlog from the eviction moratorium. That particular county actually extended the moratorium longer than the federal mandate required. So they're still catching up, but eventually they should be back to a normal speed, and then we'll be able to get people out pretty quickly.
And Charles, can you just confirm they are not still on an eviction moratorium, correct? There's no longer an eviction moratorium. They are working through the due process.
Thankfully, yes, that is absolutely true. And absolutely, that's a beautiful thing.
I think the other thing I want to just add in on that point is, because you're absolutely right, we're going to deal with delinquencies. Any property we have, we're going to. One thing I really like about this property is the break even. The break even in year 1 is 60%. So we could have 60% occupancy at our rates and still be able to pay debt and pay all the expenses. And that was one of the things that really attracted me when I started looking at the initial underwriting and making the decision on getting involved in the deal. That was really appealing.
Yeah. What you won't have with this team, with Charles, with the Admirable Group, all of my folks, is you're not going to have inattention. You're not going to have a property that is not getting addressed from a return on investor's perspective. Because I think that's the big difference between a property manager and an asset manager or management, is that what we want is to make sure that the property is occupied and the property manager is doing their thing, but that we get you the returns that we projected. Because it's a win-win. When we do that, then we obviously also win. And we invest in all of these deals. It's not like we're essentially out here getting other people to invest and we're not. We want to be part of these deals because we only put them out there if they're good deals. That's just the bottom line. Some are better than others. Always happens. But by and large, good deals is what we're looking for when we're trying to give good projected returns back to investors. I'm going to finish up, and I think we've got them all here. Just turn over to the last page, and I'll leave this on here for a little bit. This is the Admirable Group team. Winston couldn't join us today. He's traveling, but if you got the information on his presentation for Winston, his information's there. If you've got any questions about it, so he can help you through the remaining process. Of course, Alfredo, Kelly, Tim, and myself, all of our information there. And our point on all this is to make sure that you have what you need as soon as you need it. And so we're here for you. I don't have any other questions. Team, anything else you want to put out before we finish up this Q&A?
Hey, Ray, it looked like there was one follow-up question there.
Missed it.
From Luis. He just followed up. Are we replacing the management company? I think we just covered that. We are replacing the property management company. And then are tenants aware that their monthly payments will most likely be raised within the next year? And this is really a conversation that the property management company has with tenants. As renewals come up, they have designated timeframes that they start engaging with those tenants to say, hey, this is what your rates will most likely be if you choose to renew. And then that's when that conversation takes place.
Yeah, good question. I think most tenants and most of us understand that things are just going to continue to go up in price. That's just a fact of life. But I think what some of us get, and hopefully more of us get in the future, is that real estate is a good hedge for inflation. And that includes rents. Rents go up. So yes, we will continue to push the envelope without, obviously you can't push too much, because if you do, then you start having occupancy issues. And as Kelly mentioned, we've got plenty of room there, but we certainly want to keep a property in the 90 to 95% as far as occupation goes from tenants. So we won't go crazy for sure, but it's a great question. All right. Anything else from anybody else on the team? I think we got one more question from Luke. Is the intent to push a tenant's first renewal to market rate or half of such?
So the goal with any rent increase is to always go as far as we can, as fast as we can. And what that means is we're going to test the market out. If we can hit the year 2 target in month 3, then we're going to hit the year 2 target in month 3. If we get pushback and they say, nope, that's too high, and we can only hit the year 1 target, then that's what we'll do. So it's always going to be a little bit of trial and error. And it's going to be really testing the property and testing the tenants and seeing how far you can get before you get some resistance.
Absolutely. And it's also cyclical, right? So depending on when those leases are up, if they're up in the summer where it's high movement season, chances are we'll be able to do a little bit more there than if it's a lease that's coming up, say November, where you don't typically have a lot of movement going on. So some of that plays a role as well. But great question. Good answer, Charles. Anything else from the team? All right. You've got all our info. Please reach out. Don't miss out on this opportunity. They just don't come around that often. Thanks, everybody. Have a good night.
Thank you.
Have a great night, everyone.
Good night, everyone.